very good evening to all our guests here today. So, Viksit Bharat or Developed India is a significant concept that has been shaping India's overall development discourse since the past few years. It reflects the vision of transforming India from a developing to a developed nation, emphasizing on economic growth, social progress, and overall development. So, be it India's focus on becoming a developed nation with a substantially high per capita income, uh, her advancements in cutting edge technology such as aerospace, defense, semiconductor chips, or green energy transition, or be it setting up world class infrastructure capabilities to cater not only within but also to the world. One fact that all of us in this room today would agree on is that Viksit Bharat is not just an aspirational goal for us, but it is more of a compulsion or a necessity to achieve over the coming decade. With this, I would like to introduce our two distinguished guests forming the panel today. We have Mr. Arjun Nagarajan. Arjun, could you please? So, Arjun is the chief economist at Sundaram Asset Management. Arjun's career began in the markets over the last 12 years, of which he spent over 10 years at Sundaram. He has also been a part of Niti Aayog's discussion with prominent economists on topical issues very, very recently. In 2020, he participated in a pre-budget roundtable consultation with the Honorable Prime Minister of India to discuss policy measures for the budget of 2020-2021. Arjun holds a bachelor's degree in commerce, an MA in economics, and MPhil in economics from the University of Madras. He also holds an MSc in economics and MSc in finance and investment degrees from the University of Exeter, UK. Our next guest for today evening is Mr. Salvan Shah, who is a portfolio manager looking after the PMS and AIF schemes at Aditya Birla Sun Life Alternatives. Salvan comes with over 12 years of experience in the Indian capital markets, having worked with prominent domestic financial services firms such as Edelweiss Capital, Sanctum Wealth, and now he is with Aditya Birla. He's been very successful at identifying themes and stocks at very early stages, which has resulted in multi-bagger returns for investors. Mr. Salvan is a chartered accountant by qualification. In your opinion, what are the key macroeconomic trends which are supporting this theme as of today?
We need to get to a developed sort of an economy state. And what are the sectors that we really need to get? I think two no-brainer sectors in a certain sense is financials, it is consumption. Infra always is always the backbone, but I think two evergreen sectors will be financials and will be consumption, especially discretionary consumption to a large extent. So if you can actually look at the chart there, we are in that little blue segment, and that blue segment is all that we have 25 years, 26, 25 years ahead, where we really need to do whatever we need to do before India's working age population starts coming off. And if you're looking at it from financials and consumption is something that I said. Now, why is consumption so important? If you look at it globally, every single country, the minute they hit a certain threshold on per capita GDP, roughly somewhere in the range of around $1,800 to $2,000 per capita GDP, you've seen a very sharp increase in consumption of durable goods across the board. So India sort of crossed that in just before COVID, and then there was a dip, and then we started seeing a pickup. And in the next slide, you'll actually see where India's, on the left-hand side, you see China's per capita GDP crosses 2,000. And immediately after that, the red bar there is where China's GDP, per capita GDP crossed 2,000. And after that, if you see in the chart below, you've seen a very sharp pickup in motor vehicle penetration in China. On the right-hand side chart, you see South Korea in mid-1980s crossed the $2,000 per capita GDP mark. You see a very similar pickup in the automobile penetration in South Korea. You go to the next slide, you go to Indonesia, you've seen a very similar thing. So if you look at the refrigerator space in Indonesia or the passenger car space, somewhere around $1,800 per capita GDP, you've seen a very sharp 2x and a 3x jump there. So we're exactly at that phase. We are at that inflection at this point in time. So unless there's something like a black swan that really hits us, which seems unlikely, I think we should be good to go at least for the next 20, 25 years.
That's actually a very interesting statistic that you put over there. I actually have some interesting statistics for my audience over here. So, like you basically pointed out in the previous chart about China's per capita GDP, here's a fun fact for all of you. Mercedes-Benz today sells a third of its total global volumes in China alone. They sell about 750,000 vehicles in China today. About 15 years back in 2008, their GDP per capita was at about $3,500. We are today at about 2.5, so we are very, very close by. At that point in time, they were selling only 30,000 Mercedes-Benz in the country. So in 15 years, the volumes have gone up by more than 20 times. Where is India today in comparison? We are selling only 18,000 vehicles in the country today. This is only Mercedes. That's it. So I mean, that's a very interesting point that you put. So I think changing consumption patterns is going to be a pretty, very, very massive theme going forward for
Yes.
India.
Yes.
Right. So for this, Salvin, let's dive into this, what this means for the market, right? So where do you see the next big pockets of opportunity which excite you?
Sure. So, government has definitely laid out a very clear vision on Viksit Bharat, and some of the sectors where significant reforms are expected are agri, capex related, basically manufacturing, infra push, and also this will help employment generation to a large extent. So, all the allied sectors which will be allied to these spaces will see significant growth in coming years. So let's take agri for example. So the fertilizer companies, the seeds, the tractors, these are the sectors which should benefit from these reforms. Also what happens is because of the upliftment in the rural income, there will be a strong demand for the rural housing and of course consumption. Because of the manufacturing infra push, obviously domestic cyclicals will be the key beneficiaries. But these are all first order impact. If you look at the second order impact, as Arjun also mentioned, consumption and financials are the ones which will be the key beneficiaries. But having said that, these are the sectors where the growth is expected to be quite strong, but investors need to be vigilant of the entry-level valuations. I think that's something which one needs to be very careful about. Just a word of caution.
That's a fair point, Salvan. So according to you, which are the sectors which are actually ripe for a re-rating today?
So if we see last 1 to 2 years when we've seen very sharp rally in the market, there are certain sectors which have not really participated. So, private banks is one of the sectors where over last 2 years, they have significantly underperformed the market. And now if you look at the valuations, they are quite attractive. The sector is available at roughly around 2x price to book. This is quite attractive whether you compare it with the historic valuation or you compare the multiple as a premium or discount to the Nifty multiple. So if you look at the chart out there, this is the chart where I have compared private banks valuation multiple to the Nifty price to book multiple. Historically, this has traded at a marginal discount to the overall Nifty. But over last 2 years, we've seen a significant derating in the sector. As a result, private banks are now trading at good 30% discount to where the market is trading, as opposed to some 9% discount that the sector has traded in last 10 odd years. So this is one sector where definitely the sector has its own challenges, but if someone has a medium-term horizon, this is definitely a sector where big money can be made. Another sector which is also going through a similar story is insurance. So if you look at the insurance companies, so these most of these companies got listed in 2017, 2018, and post-listing these were trading at roughly around 3x to 4x price to embedded value. Over a period of time, these companies have significantly derated, and now they are available at 2x kind of price to embedded value. Now, with the growth coming back, again, this is the sector which can see a rebound in multiples. Apart from these, one can also find opportunities in pharma and IT, but here one needs to take a bottom-up approach. It will be very company-specific.
Fair enough. So conversely, which are the sectors you think are probably ripe for a de-rating today?
Very relevant question at this juncture. After a steep rally over last couple of quarters. So see, obviously there are excesses in the market today, and there's no denial about it. And we have seen this in past as well, right? I mean, we go back in the history. There has in every bull market there is a particular pocket which gets into the bubble zone. Whether you go back in 1990s bull market, we saw tech, which was in the bubble zone, 2006, 7, 8, when infra and power and real estate was in the bubble zone. And we know how it ended, right? It was quite an ugly ending. So today, also if you see, there are definitely pockets where the valuations are, looks like they're defying gravity. One of the sectors, if you look at public sector defense companies, these companies are trading at abnormally high valuations. So, they are trading at 15 to 18 times price to sales, 10 times price to book. Historically, they've traded at barely 1/10 of this multiple. So definitely they're quite expensive with, they're kind of factoring in 22 years of very strong growth going ahead. I mean, that's the only way one can justify this kind of multiple. And we know, I mean, 25 years of strong growth, that's a very low probability event. So this is one sector. Even railways, for that matter, they're quite richly valued, I would say, good 6-7 times revenue. Historically, they've never traded at such expensive valuations. So these are few of the sectors where one needs to be cautious.
So then, the question I have, and I'm assuming a lot of people in the room have today, is then what do you think of the overall PSU space? I mean, are there more legs to the rally over here? Because PSU was a very hated sector up until 2020-21, right? For 10 years, it was in a value destruction phase, and the last 3 years have been nothing sort of spectacular, right?
Yeah. So, see, you can't paint all the PSUs with the same brush. So PSU defense definitely, as we saw, looks like in a bubble zone. But look at a lot of other PSUs like metals, OMCs, public sector banks. They are trading at a very reasonable valuation, I would say. Plus, these companies have decent earnings growth expectations. Also, these companies are high dividend yield companies. So both these factors, high earnings growth and high dividend yield, will provide support on the downside.
Fair point, right. So let's shift gears, Arjun. Coming back to the Bharat in Viksit Bharat, right? So often has been a comparison between us and our next door neighbor, China, right? Frankly, is it even relevant to compare India versus China as of today, given where we are in our overall evolution?
Fair question. I think the answer is no. So I think there are a couple of slides I want you to see. Just let that sink in. Just take a look at those two bubbles. They are to scale. So let that scale sort of sink in. China is roughly around $18 trillion and we are somewhere around $3.6 trillion. Now, we're talking India will grow historically, you look at the last 10, every decade, the last 5-6 decades, India has always grown at around 6%. We are now in that 6.5-7% range from that 6.5. we're never going to grow below 6. If you look at China, China is at 5%, probably they'll moderate to around a 4.5. Even if China grows at 4% every year, every 4 to 5 years, they will put out a little India. Every 4 to 5 years. So I don't think there'll ever be a catch up from an India point of view. I think this one brings that very beautifully. So as of 2022, India was where China was in 2007. And by 2031, good optimistic assumptions, 2031, India will be where China was in 2011. So which means a 20-year gap. I don't think that gap will ever close unless you probably expect politically China to sort of break up into 4 pieces, 5 pieces in that sense. Then India will be the second largest economy, it won't be the third. Now, the point is that every democracy will always grow at a slower growth rate. That is the price you pay, and that's a good price to pay for being a democracy. China is not a democracy, so your growth rates in that early 2000 to 2010-12 phase has been just off the charts. So from an India-China, I think it is better for India to focus on its strengths rather than make a comparison to China, because politically there is no comparison. From any other angle also there isn't a comparison. I think probably we can learn from China's mistakes and probably also learn from what the right things that they did. So one small interesting point was that this is, I think, the first time officially the economic survey that the government presented just before the budget made a very brave and a very sensible mention saying that, hey, we have to actually look at Chinese FDI in India because we really need technology that we have to learn from them. It doesn't really matter that it is China, because if the China plus one does come and there's a lot of shift in demand towards India, if we don't have the capability and the technology, we'll still be so dependent on China. So there's a national security issue as well, but then there's also a skilling angle, a technology angle to it. So this entire India-China narrative, I think it's time to sort of put that in an entire perspective. We have to actually play to our strengths. So I don't think we can do what a China did in that sense, because the political systems are different, but you know that the direction is pretty much the same. The time in which you reach there will probably be very different.
So that brings me to my next question. Actually, let me break it up into two parts. Number one, we are today at about $2,500 GDP per capita, right? Viksit Bharat is our goal in 2047. How do we really avoid the middle income trap? That's one. Secondly, historically, India has been able to get that, a leg up in growth, primarily supported by services as an economy, right? Whereas China's policy to grow was basically through manufacturing, which is what we are trying to do today. So how do you sort of marry these two concerns? Can India really grow that exponentially by 2047? If yes, what will be the drivers for growth? And will it help us to sort of beat the middle income trap?
Yeah. So if you can go back to the first chart on demographics that you actually showed. So what we lost out was, if you actually look at India's demographic dividend, India's demographic dividend started somewhere around 2060s, and it went on all the way, and it's getting over only by 2050 or so. China didn't have that advantage. China started in mid 2070s and it got over by 2015. We lost nearly 3 decades of demographic dividend for whatever reasons. So the entire manufacturing drive has 2 legs. One, it is trying to catch up on what we lost. We can't catch up. The bus has sort of gone to a certain extent, but I think there's still a fair bit that is left. And if India doesn't take that share, there are countries that are waiting to near shore, friend shore. There are countries that are really waiting. And India is at that inflection where jobs are very important. So manufacturing, I think, is very important. Now, if you look at manufacturing as a percentage of GDP, it's very small for India. It's only around 17-18%. But it's actually the heart of the entire engine. So even though manufacturing is only 17%, if you look at services, half of that 55% services that you talk about is directly linked with manufacturing. Trade, hotel, transport, communication, housing, warehousing, everything is actually directly linked with manufacturing. So we actually look at only that manufacturing share. We don't really look at the impact that it actually has on other sectors. Now, this entire manufacturing and services narrative, I don't want to be political here, but I think it's come after certain comments have been made saying that no, we should actually focus only on services in that sense. But I think that argument my 2 cents is probably it might not be well sounded, because manufacturing we have to focus on for two reasons. One, jobs. Second, we are also at a point in time where every country wants to do manufacturing of all the sensitive segments in its own country. So for both reasons, I think manufacturing is important. Even if you take away, even if you don't want to focus on the importance of manufacturing for services in that sense. 50% of manufacturing is directly what services actually needs. So I think we have to focus on manufacturing. So the PLI narrative is actually very important. But one other thing we have to remember is your allocations to PLI, it is still in the few thousands. So, and PLI, the whole idea of PLI, we have 15 sectors, a couple of sectors have really taken off fairly well, and electronics, the entire narrative actually picked up even before PLI was introduced. PLI sort of helped it even more. So, it is trying to build an ecosystem, and it takes at least a decade to build that ecosystem. So, if we continue to push up these incentives for at least another 5-6 years consistently, and I think we should be there. So if you just look at, I think Apple's suppliers in India in 2018, we had I think 2 or 3. We currently have around 18, 19. One can argue saying that they are all Chinese suppliers and they're only assembling in India, but it starts there.
Fair enough. So, that brings me to my next question, probably the last one for the evening. So, what do you think, in your mind, are the key risks to the entire, Viksit Bharat theme that we are trying to play for the next couple of decades?
Yeah.
Anything that concerns you?
Yeah. So, three things. So, one is your fiscal deficit. So, fiscal deficit is a very important narrative. We really need fiscal deficit to come down. But every action has an opposite reaction as well. In the sense, everything that we do, there is another side to it. The more the government drives down the fiscal deficit, the more the government's support for growth is also coming off, and the reliance on private to sort of take that place increases. So we have to sort of, this entire aggression on fiscal deficit is good, but I don't think we can afford to do it beyond 2026, and which is probably, I think the government understands that, which is why very subtly in the budget they made a mention saying once we reach that 4.5%, we'll shift to debt to GDP as an indicator rather than fiscal deficit. So that is one risk, in the sense that we can't continue to do that. Second is, if you actually look at it from an India and global growth point of view, India is neck deep in globalization. This entire narrative of deglobalization, decoupling, I don't think numbers support them. So if you just plot India GDP growth and US GDP growth, for decades now they actually move hand in hand. And more importantly, we're all investors in the market. So if you plot the S&P 500 and you plot the Nifty, directionally, the last 25 years plus, they've moved exactly in the same direction. There's not been any divergence whatsoever. So I think anything that happens globally is definitely a risk. So one risk is over focus on fiscal. Second would be something that happens globally that might impact India. Third is, which is not as much of a risk, at least at this point in time, but maybe 2025 can be a focus. From a currency point of view, India is actually doing fairly well. Our balance of payments is in marginal surplus. But directionally, you look at it, we're still an importing country. We're still a net importer. So if that GCC narrative around services really, we don't know whether it is going to structurally change. There's a lot of optimism there. But nevertheless, that external focus is very much there. So historically, we've always seen the currency depreciate by around 3.5% or so over the last 30-year average, if you see. So if there's too much volatility around the currency front, at least in the near term, that could be a risk for India. So 2013 was something that we actually lived through. So I don't think that will happen, because the RBI is very conscious that it does not repeat again. But nevertheless, that is a risk. But the more obvious risks is just global. Whatever happens global, we are in a globalized world. So if US sneezes, we will catch a cold.
Fair enough. Salman, according to you, what do you think is the key risk to the Viksit Bharat theme today?
So, I think, the biggest risk I see currently is a lot of growth that is baked in. And I believe the biggest risk is that if the policy reforms are delayed a bit, and which eventually leads to the earnings getting delayed, that is, I think, the biggest risk that one can see. So, and that has happened, right? I mean, if you look at the Nifty earnings, okay, over last 10 years, 2012 Nifty EPS was 496. 2018 Nifty EPS was still at 496. So for a good 5 6 years, we did not really see any earnings growth. Most of the growth that we've seen has happened only after COVID over the last 3 4 years. Now going ahead, we are building in 15 odd percent kind of growth at Nifty level. If you look at the mid and small caps, the kind of growth that most of the consensus is building in is far higher than this Nifty growth. And that is something that is also baked into valuation. So if you look at the valuation chart out there, Nifty is trading at 21x, which is more or less in line with the historic average. But if you look at the mid caps or even small caps, they've baked in far higher growth in the evaluations. So today, definitely, we are at a far better place than where we were 10 years back. Definitely the growth is better. The corporate balance sheets have been delevered over 10 years. The banking asset quality is at its best currently. So definitely we are at a better position than where we were 10 years back. So at Nifty level, I believe this number looks quite reasonable. But pockets of mid and small caps is where there's a lot of growth which is baked in, and I believe any delay in earnings can lead to severe capital erosion. Also, in terms of risks, see, of course, there are no other visible risks as such, but what we've seen in past is that it's more of a it's not the known unknowns which really leads to sharp correction in market, but it's the unknown unknowns which lead to which drives the market down very significantly. So no visible risks as such, but yeah, some kind of Lex Swan event can lead to sharp drawdowns.
Fair enough. That's a very fair point. So with this, we would like to conclude our session on public markets. The conclusion is this, that when it comes to the long-term growth story for India, it's absolutely rock solid as of today. And as Salvin pointed out, we have we have the dual tailwinds of having strong balance sheets both for the financial sector as well as corporate India. And coupled with that, we also have a very, very young population, a working age population, which is coming into the economy, where per capita income is also on a steady rise, which will also drive consumption. So you have all levels of India's growth, kicking in. You have consumption, you have investment, you have manufacturing, you have services. They are all coming together at this point in time. However, the only cloud on the horizon is basically valuations. Probably a lot of the near-term optimism is already baked in today's prices. But from a long-term investment perspective, if you have an outlook of more than 5 years, even today, there are lots of pockets where you can definitely put your money to work. With this, I conclude today's session. I would like to extend a round of gratitude for my speakers here today and giving us their valuable time. I would like to request Sumir to come on stage and give a small token of appreciation from our side to them. Sumir?
Coming down and sharing with us your insight.
So any questions from the audience, be it on stock markets or on sectors, on valuations, on geopolitics, we are most happy to take those.
Well, I think somebody should definitely explain to me what's happening with Japan and why are we suffering from it.
That's actually a very fair question. So why don't we Arjun to answer that. Basically, I guess the concerns around the yen carry trade, right? Yeah, and the risks which permeate from that.
Give you three things. The third thing I'll talk about the yen. First point, the entire narrative started a week ago when everybody was talking about a recession in the US. The base case that we've been talking about from start of 2022 is that the US is not going in a recession. The economy is far too strong for it to actually move into a recession. There was a concern around a recession same time last year when SVB collapsed, but the Fed really was very swift and they took care of that. So I don't really see there's any recession risk at this point in time. Growth will slow down in 2024, but it's not going to be a knee jerk. It's not going to be a recession. Second, the concern in the market is around the September rate cut. We are saying that, see, the Fed is not going to cut in September. It's only going to be in 2025. One thing is that this answer is related to yen, so which is why I'm also rattling around. So central banks cut rates only when growth really comes off very sharply. If they cut rates when growth doesn't come off, then you will see a very sharp pickup in inflation very soon, and they have to deal with inflation all over again. So the last thing they will be doing now is to cut rates. It's only going to be 2025. If I'm wrong, I think the worst case, I think, will probably be a December. Now, the yen. Why did the yen react? So there are two things. So Japan for decades now has been trying to bring back inflation into the country. It hasn't really happened. COVID, in a certain sense, came as a blessing in disguise because inflation really started coming on. And after inflation started coming on, they started really pushing the corporate sector to raise wages. So you saw nearly somewhere around the 5.3% increase in wage growth in China that hasn't happened in the last 30 years, the highest that you've ever seen. So that is inherently bringing a certain income growth, a certain pickup in retail sales, etc. that Japan wants to stay. Now, it was also in a negative interest rate regime, and they wanted to come out of that because as long as you're in a negative interest rate regime, it's like a perennial trap that you're in. So they started, I think in December last year, they said we're going to start changing it. In March, they hiked by around 20 basis points, and then around last week by around 15 basis points. Now, from 1998, your policy rate in Japan was around 50 basis points. Oh, I'm actually sitting down, sorry. The policy rate in Japan was around 50 basis points. It is currently at around 25 basis points. So it is just 25 basis points before that. So from 1998, there has actually been a secular carry trade that has been going on in the yen because you could borrow the cheapest in yen and invest all across the world in different asset classes and make money in the asset classes and take it back, repay your debt and still make a lot of money because directionally the yen was very weak. Now when interest rates are coming back up, the weakness in the yen is turning around because when you say, let me give you a simple example. US is actually raising rates. If a central bank is raising rates and the opposite, say for example, the Bank of Japan is actually keeping rates unchanged, that entire rate differential will translate into weakness in the currency. Now when the US is actually expected to cut rates and Japan is expected to increase rates, rate differential comes down, which means the currency is going to start appreciating. And that was the biggest concern in the markets. Markets felt US is going to really aggressively cut rates, which I don't think is going to happen. And the markets were saying Japan is going to aggressively increase rates, which also I don't think is going to happen. So that was the entire reason why yen started appreciating and this entire fear of a carry trade unwind. Now, US I don't think is going to start cutting rates aggressively. It might only be end of this year or start of 2025 with a gradual rate cut you will see. Bank of Japan, I don't think they can afford aggressive rate hikes because we have to understand rate hikes means you have to bring down growth automatically. It will automatically bring down growth. And Japan is at some 0.5% GDP growth. So I don't think they can afford aggressive rate hikes, unlike what the markets are saying. So this entire narrative, I think it will just die its own death. The yen might settle at around 140, 148, it's at 146 to the dollar. I think it will settle just under the 150 per dollar mark, but I don't really think this will really snowball into anything more concerning. I think I've taken a very, very long time, I'm sorry. Yeah, please. Yes.
One aspect when you compare with China when it was 20 years back or Indonesia, I don't know what is the Gini coefficient at the point. Because one of the data points which I also see is,
Yeah.
while you talked about $2,200 of GDP per capita, if you take out the top 5%, which is 7 crore people, we are down to $1,000. Right? When you look at that picture, then it doesn't make sense because you're only targeting the 7 crore as a consumption story, right?
Yeah.
Is it really going to impact us? Are you going to really see that consumption take off the way you're projecting?
So the thing is, India's GDP growth is going to go up. The directionality is very much there. That composition is up to the government and the government's policies. That the top 5 or the top 10 having 80% of the wealth, I think that the Gini coefficient, the inequality, I think is fairly high in India. I don't think there's any argument. The simple fact that you're hearing narratives of wealth distribution, I think itself is an indication that it is reaching a certain threshold point, which also is something that the budget saw in its narrative, in the sense that I think a part of the election outcome also was a reflection of that inflection that was happening underneath, and that employment-linked incentive, the subsidy that is now in a new form, is also a reflection of that. So directionality, I think India is still going to go that way. I think it is government policy that have to really see to it that they can bring about jobs. So wealth distribution is not the answer. It is only growth and jobs that is very important. I think we need really 8 million per year. If we can't get there on an annual basis, the narrative around wealth distribution will only get louder, at least politically or socio-politically speaking in that sense. So that is a risk. We need to really get that 8 million every year, however, by hook or by crook. So for that, I think manufacturing becomes very important. Services is a derivative in a certain sense.
Really run very fast and furious too. So what is the growth story going forward? Basically, you say that the jobs is one of the biggest gotcha in the entire thing. And from looking from outside in perspective, the U.S. markets are still, at reasonable levels of valuation, but the Indian markets have outpaced. What does that mean? Even if there's a year blip in the job creation or something, may not be a black swan event too.
Yeah. So I'll, at least from an economy point of view, I'll just give you two numbers. So your nominal GDP number is roughly around 11-12%. You break that down very simplistically speaking, it's 7% GDP and 5% inflation. That's what your nominal GDP number is. More realistically now, maybe in the next couple of years, it might come down to 6.5% GDP and maybe 5.5% inflation. It might come down to around 11%. So your market, your large cap CAGR is invariably somewhere close to your nominal GDP number in that sense. So I don't think we will have a problem hitting a 6.5% GDP because that basic autonomous growth is already there. And 5.5% inflation also, I don't really think. So I don't think there is a threat to that 11% nominal GDP growth, which means that historical market CAGR, I don't really think there should be a problem. The issue is from here, how much more can we get? Can we get a little more juice on growth? Can we go and stay at 7.5, 7? I think that's the question. For that, you need jobs. If that doesn't come, you will still grow at 6.5. At average decadal growth of 6% will be at 6.5. At 6.5, you will still grow at that, provided there is no disruption globally. So I don't, from a long-term CAGR perspective, I think the simple fact that we're still underpenetrated and that autonomous growth is still there, I don't, that 11-12% CAGR from a market point of view, I don't really see a risk to that. But can that get better? Can the mid and small cap space see a little more juice? Can there be much more growth there? Can that alpha come through? That will depend on the growth narrative.
Okay, so I actually have a question for Salvan. You interestingly, pointed out a pocket of opportunity, particularly in the private financials space, if I'm not wrong. I think a pocket of the market is worried about two factors in that particular sector, which is why it is available at a discount today, right? Number one, I think there is basically all this talk around scarcity of deposits. Banks are struggling to raise deposits today because a lot of the money is finding its way into the market or wherever else, right? The other issue that people are talking about is a lot of the growth which happened in private financials over the last few years was particularly on the retail lending side, more to do with unsecured lending, which is a pocket which may be facing stress, maybe not today, but maybe a few quarters from now. And that basically has the market buried, right, leading to the derating. So, any thoughts around these two prime concerns?
Sure. So I completely agree. The deposit growth obviously has been lagging the credit growth over last 7, 8 good quarters. There's a good 3 odd % kind of gap, and that's not because the deposit growth has slowed down. Primarily, it's because of the very high growth in credit. And this is not the first time that we are witnessing such kind of gap. If we go back in 2000s, 2004-5 onwards for next 3, 4 years, the credit growth was far higher than deposits. So credit growth was upwards of 15, 18%, and deposits have always been growing at 10, 12% in the best case scenario. It's just because in the last decade we saw credit growth. At a very low number, at 12 or 12, 13% kind of growth in the credit. That is why we couldn't really see the gap. Having said that, the credit growth is expected to be in mid-teens number, and deposits will eventually, obviously, will have to catch up because your loan to deposit ratios cannot go on for go up forever. So there is definitely going to be a fierce fierce competition in this deposit growth. And that is something which is also going to lead to some kind of higher rates, and as a result, some kind of NIM compression is what one can expect. But what one needs to see is current NIMs of most of these banks are anyways higher than the normalized levels. When most of these banks were operating at 3.5 to 3.8% range, these banks are currently at 4 to 4.2% kind of range. So there is definitely some 0.5% cushion there for banks to get to the normalized level. So yeah, the NIMs will obviously compress in order to fight the deposit war.
So, in your opinion, that's probably in the price today, which is what is getting reflected.
Yeah, the valuations definitely factor in much worse than that. 10% kind of contraction in NIMS is. I mean, the valuations are kind of factoring in far more worse impact of this deposits war.
Right. And the second part of the question, with respect to fears around, asset quality.
Right. So, see, this is something which RBI has been highlighting since quite some time now, and banks are also quite vigilant about it. But if you look at the overall system, at system level, this is barely 10% of the overall credit. And plus, at an individual level, we are not overly leveraged. So, I think that is one plus point. While we haven't seen very significant stress out here, there is definitely some of the corporate commentaries indicate that there is some stress built up in some pockets. But I don't see this as a very massive issue. Unlike what we saw in last decade over the corporate loan bad assets, this is because the same history is not expected to be repeated. The reason being corporate loans formed good 50-55% of the total credit at that point of time. Today, personal loans barely make for 9-10%, and that too, most of these large lenders will have a mix of lower than 10%. So, not a systemic issue in my view.
Fair enough. Right. Just one last question we can squeeze in.
Sure.
I think, and this is probably on everybody's mind over here. So there are two events, which are concerning India. One is obviously the tension which is boiling in the Middle East, right? Are we opening a third front with, Iran coming into the fray? What does it mean for crude oil prices? And historically, we have been an importer of crude, right? The other issue is with respect to the Red Sea crisis. How does it impact the export story for India? How does it impact our exporters? And the Bangladesh crisis, exactly.
So let me take that first. See, Bangladesh is a very small economy as compared to India. It's like 1/10 of India size. For us, I think on the negative side, there's not no very severe impact, I would say. Positive side is basically, so Bangladesh has been a very big exporter of textiles, right? Almost 85% of exports of Bangladesh is textile exports. So that is a small segment where I think one can benefit because textile from the global textile trade, a big player is out of the market. As far as the impact of crude is concerned, definitely crude, India being the third largest consumer of crude in the world, any spike in the crude price is going to have a very severe impact on our economy. And so I think RBI is working with $85 crude and 82 and a half INR USD rate. Currently, the crude is obviously at a lower number, sub $80. So any spike in crude can kind of mess up the fiscal math out there. So because of that, so it can have severe impact. One is because of the change in fiscal math. One can see rupee also depreciating. In addition to that, most of these companies which have crude or crude derivatives as their raw materials can have a severe impact on their margins. So and also what happens is when the crude prices go up, even other commodities will shoot up. They will also move up hand in hand. So as a result, there can be an inflationary scenario, and in inflationary scenario, we know how Fed and RBI are expected to react. So the rate cuts can get further delayed, and which in turn can lead to some kind of derating.
Thank you so much, Salvan.